Ciao ladies and gentlemen, welcome to my channel. My name is Cullen Gandy, coming at you with another invaluable piece of advice regarding mortgage finance or personal finance or just general lifestyle advice to get you where you want to be financially down the road so that we're all a little bit happier and hopefully a little bit richer. So if any of you guys are like me, you have a few regrets in your life. I mean, it's not like you're just a bundle of regrets constantly looming over your life choices or anything. That would be exceptionally sad. But I bet if a lot of you had the chance, you'd love to talk with your past you and give yourself some advice about what's important, especially about your financial life and when it has to do with your credit. I know I'm like that, but sometimes life when you're young, everything doesn't really pan out the way that you want it to. Unexpected stuff in your financial life really can make a big difference in your quality of life. And you never can see some things coming. No, baby, don't pan down when we're wearing the fish shorts. I told you never to pan. You're getting closer. It's a tighter shot on the fish shorts. But if there's one thing that I could go back in time and just grab hold of myself and give myself some better advice, it would be how to use and build credit. And for a certain period of my life, I was an established member of the Poors. And as an established patron of that certain social class for a good portion of my life as an artist, I figured out there's a lot of really important stuff that goes along with building your credit, keeping your credit in mind when you make future decisions about your life, and how you should go about managing it when you're real young and maybe don't make that much money yet. So, if you manage your credit well early on, you can actually increase your net worth later on, even if you sort of just make the same amount of money by having the credit available to you to get really great returns on assets like homes and other sorts of niche things like cars, maybe Bitcoin. Who knows what's gonna do, $1 million on a Bitcoin. So if you're interested in these kind of topics, stick around. I'm gonna be showing you all about how to build credit early on for success later on. By the way, guys, hope that you like smashing like buttons because this is where I want you to do it. Also, let me get that subscribe. You know what I'm talking about. Hit the subscribe button, hit the notification bell so that I can keep bringing you more just delicious content. Just absolutely just scrumptious content just like this. Thanks so much, guys. It helps immensely with the YouTube algorithm. I'm trying to get paid eventually. So when you're really very young, I think a lot of people think that they are both physically and financially invincible. And the financial markets actually know this and try to prey upon you whenever they can. One of the things that I would have done if I could have gone back in time is that I would have slapped the Nintendo out of my mom's hand when she gave it to me for my, I think, 10th birthday. That was a no-go for me from the start because for the rest of my adolescent and adult life, I probably poured more money into consumer stuff that I hardly have any use for than I would like to admit. However, when you're building credit, it's important to keep your vices and your pain points in mind and use them to your advantage. How? One, when you are able to apply for credit cards and things, since you have been used to buying things on impulse or buying things and collecting them, use a credit card to budget and make one very calculated purchase per year. I still use this as a practice even when I have almost $100,000 in credit available to me to keep this idea of keeping 3% or under of credit utilization so that my credit score increases over time. If you make one purchase that keeps you to within that range and you pay it down, this establishes a credit transaction history that can push you forward and can increase the lines of credit. In fact, the first credit card that I ever applied for was a Gold Delta Amex. And I bought the Amex because out of Atlanta, there was a lot of flights going to and from everywhere on Delta. So I thought I'd try to cash in on those points. Now, if you live anywhere else and you don't really fly that much, there's not that much benefit, especially when you have to pay a fee every year. First things first, budget your purchases, but then make a calculated purchase to establish credit worthiness for when you need to make larger credit purchases down the line. The second main consideration that you're going to want to be making when you're messing around with increasing your credit worthiness is the decisions that you make early on after you get out of high school, whether or not you're going to college, how much you have set aside for college, and how much you're going to have to take out loans for. Now, if you watch other finance channels that shall not be named it this time. You would liken student loan debt to a little bit more of like a disease of some kind. However, I'm not going to really go on that route because I think that there is a lot of value and even a lot of intangible value that is added from a college education. However, if you don't know how much you're going to actually need to be taking out in loans versus how much you're setting aside for a college degree, you really have to know what your degree is going to be worth after you get out. Because if you don't, you could come out of a major university or conservatory of music somewhere with almost 6 figures of debt. I don't know who would do that. That's a ridiculous thing to do. But seriously, you really need to understand early on what your degree might be worth and whether or not there's a cost-benefit analysis with your passion and what's practical. These two considerations are really important because of the third thing, which is to say that all of the credit you build on early on in life is going to affect you when you eventually try to get one of the biggest assets that's tangible that you're going to hold on to, which is your home. This is a huge pain point in the millennial generation, of which I guess, am a part. Because when you're trying to apply and get into a home and when you're trying to qualify, one of the worst things that we see pop up on a credit report is your student loan debt. Currently, because of a certain kind of situation that YouTube doesn't want us to know about, I don't know what could be keeping us in our homes, student loan debt payments are being halted and no interest is being accrued on those loans. The downside of this is that when someone is applying for a loan currently under Fannie Mae and Freddie Mac guidelines, all of those payments have to be listed with a 0.5%, if not a full percent, represented per month as payment towards student loans, unless you have a priorly agreed upon and documented student income-based repayment plan. So if you're a doctor and a lawyer and you're just jamming out of college and maybe you haven't found your next big gig yet, or maybe you just don't really know where you're going to find work as a practice and you don't really have the income to show for it, this could be a problem if you have a little family and you want to get a starter home. Debt to income ratio is one of the biggest disqualifiers and one of the biggest things that gets loans denied in my industry. I come across it all the time and it always has to do with one of two things. Is your debt to income ratio above 50%? If it is, obviously you're not going to be qualifiable. And also, is your credit score above 640? Because if it's below that, I mean, heaven help you, because we're not going to help you. That being said, if you've had a bankruptcy or if you currently have really bad credit, it's no problem to get onto that right now, repair that, and come back stronger than ever before. Now, on the lighter side of the credit game, how you can build it can sort of be what I like to call gamified. If you're trying to build credit, build it around your pain points and also what you really enjoy doing. For example, I have this YouTube thing that I buy a lot of things off of Amazon for, so I got an Amazon card, and it gives me another return on my investment that I wouldn't have just gotten otherwise if I had paid directly out of my bank account. In fact, this strategy has been talked about on the financial YouTube sectors forever, and it's the idea of churning out credit cards for different kinds of benefits, whether they be points. In the case of an Amazon card, I think it's by Chase, you can get 1 point for certain kinds of purchases and 2 points to 3 points for other kind of purchases that have to do with Amazon or certain companies that Amazon invests in. Also, it's important to know that under the Equal Credit Opportunity Act, everybody is supposed to have a credit report available to them by going to annualcreditreport.com and pulling up their credit so that they can have a bird's eye view of what they need to do better in order to get themselves to where they need to be. When you're applying for credit, it's really important to understand that hard pulls are only temporary, and if you have something that you really need to pull credit for, go ahead and do it, execute on it, because credit comes back, but you might not be able to lock in, for example, really good rates on a mortgage or get a really exclusive kind of card right away, and the terms may change later on. And also understand, when you're at the end of your credit game, how pulls actually work, because if you're shopping for a certain kind of asset, it doesn't matter what it is, whether it's for a car or a home, that first pull that you make is going to be a hard pull that does affect your credit somewhat, but If you're shopping around a little bit after that, you have up to a 2-week period where every pull after that is considered a soft pull and won't affect your credit as much. The biggest no-go when you're trying to manage a good credit score is to make late payments or only making minimum payments if you have a 3% or more credit balance to credit utilization. So you want to keep on top of this, and while you're using credit, you want to make sure that you pay it off sufficiently enough to where you're actually helping your credit score rather than hurting it. And also know how interest works, because just like interest can compound when you're investing, interest can also compound you in the face when you're owing someone else, especially when you have credit cards that are 14% or 20% APR over time. That's it for this video, guys. I'm going to go into a little bit more detail on how I manage my own life and my own credit right now, because I have my own issues that have to do with exorbitant amounts of student loan debt, but also just generally budgeting my own life and the tips and tricks and things that I used while I was sort of relatively poor to get myself to where I am now, to where I have a fairly comfortable amount of disposable income. Thanks so much, guys. And again, please just let me get that like, just please subscribe, and I hope to see you in the next video. Until then, peace.